Exhibit 2, Mr. Talwar's portfolio and the annualized returns, each asset class generated for him since 1990. Source Ambit Capital returns for house number 2 are on the basis of its current value in the resale market. Mr. Talwar held his head in his hands. The past had to be left behind. Nikhil comforted Mr. Talwar. But at the same time, Nikhil said that if Mr. Talwar did not learn from his mistakes, he was starting at a very uncertain future. It was important for Mr. Talwar to assess the kind of returns that he would need from his portfolio. The required returns were actually a function of the financial goals he had in the coming years. Mr. Talwar, guided by Nikhil, wrote down his primary financial goals. See Exhibit 3. Exhibit 3, Mr. Talwar's financial goals along with the current equivalent costs. Number 1, Akanksha's higher education, cost in rupees lakhs as at today's price, 80 lakhs, year of coal 2021. Number 2, Ronit's higher education, again 80 lakhs 2025. Third, Akanksha's wedding, 70 lakhs 2024. Ronit's wedding, 70 lakhs again 2028. Buying a holiday home, 100 lakhs, that is 2027. Buying a car, 10 lakhs every 3 years. International vacation, 5 lakhs every year. When Nikhil uploaded these goals on the financial planning software, he had to account for an important adjustment, that is inflation. The current cost was compounding at the rate of inflation and becoming uncomfortably high at the time of actual occurrence. For example, Akanksha's wedding, which would be costing rupees 70 lakh now, would cost 1.2 crore rupees in 2024, assuming an inflation rate of 8%. The software showed the devastating effect inflation would have on Mr. Talwar's cash flow. It showed that at the current rate of savings, that is income minus expenses, and returns on his investment, his standard of living would come drastically down once he retired at the age of 60. The cost of his goals was going up considering an inflation rate of 8% per annum, whereas his portfolio, in its current shape, having grown at 4% per annum for the last 27 years, was only likely to grow at 6 to 8% per annum. Therefore, to meet the goals shown in the preceding table, Mr. Talwar would need to dig deep into his meager retirement corpus, which in turn would severely compromise the quality of his life he and his wife would be able to lead after retirement. On the first iteration, the software showed that his portfolio had to return 21% per annum on a post tax basis from now if he had to meet all his financial goals. This sort of return was absolutely out of reach for Mr. Talwar. Nikhil then went over the exercise again after bringing down the frequency of vacations, changing cars, and excluding the goal of buying a holiday home. The required return came down to 16% per annum. Given that there was only so much he could expect from his salary and bonuses over the years, his future depended on how well he invested his savings hereon. He had seen a time when he had earned returns as high as 80% on his investments, but in the end, those returns had averaged out to disappointing 4%. He was at his wits' end. He did not believe that there was anything that could deliver a post tax return of 16% per annum over the next 10 years. The solution to Mr. Talwar: use the power of equity. Nikhil told Mr. Talwar that it was a mistake to not invest in equity. Mr. Talwar had burned his fingers with stocks and now considered it as risky as betting. After all, he had never made money in equity investing. Nikhil told him that this was because he was making the classic mistakes. One, he was trading heavily. They calculated that over the years, Mr. Talwar's average holding period was 4 months and up to 80% of his stock investments had never lasted more than a year. Mr. Talwar's high turnover was a broker's delight. In fact, he was paying up to 7% of his portfolio value each year as brokerage. There was no way, Nikhil told him, that he could have generated any returns with such investment practices. The other mistake Nikhil told him was that The other mistake Nikhil told him was that he was an irregular investor who was always trying to time the market. Instead of being invested, he came in and went out as he saw opportunities. This meant that he effectively ended up entering the stock market when the market was peaking and exiting when the market was bottoming out. Nikhil told Mr. Talwar that equity markets had high volatility and the only way to consistently make returns was to stay invested. For the uninitiated, volatility refers to the amount of risk and uncertainty with regard to the size of changes in the value of a share. This broadly means that the price of the share could change dramatically over a short period of time in either direction. Nikhil's message to Mr. Talwar was clear. More often than not, stocks appreciate when one least expects them to, and they do not appreciate evenly. Thankfully, Nikhil told Mr. Talwar that he still had time to correct his course. He had 10 years to go before retirement, and hence there was enough time for equity to work its magic. Since its inception in 1979, the BSE Sensex has delivered a compounded annual return of 15.8%. Judicious stock pickers had delivered far more in this time period. This 15% return, net of tax since stocks have zero long term capital gains tax, compared favorably with the pre tax return of 4% that Mr. Talwar had historically earned on his portfolio. To highlight the difference and show the power of compounding, Nikhil showed him the final value from each asset class had Mr. Talwar invested 1 lakh rupees in 1990, the year he started his career. See the exhibit below. Exhibit 4, value in 2017 of 1 lakh rupees invested in 1990 in various asset classes pre-tax. So, reading the chart, census would have given 34.2 lakh rupees at the end of 2017. Gold would have given 11.2 lakh rupees, debt would have given 9.3 lakh rupees, and cash would have given 2.9 lakh rupees. At the end of the meeting, Mr. Talwar was a convert. He realized the mistake he had made and understood the long term benefits of equity investment. He swore to become a patient and disciplined equity investor, which Nicholas assured gave him the best chance of undoing the damage that he had done to his net worth over the years. Mr. Talwar agreed to invest 80% of his overall corpus, up from almost nil, into a long term equity portfolio. In the final chapter of the book, we will examine in detail Nikhil's plan to help Mr. Talwar meet his goals and have a reasonably comfortable retirement corpus. Nikhil meets Mr. Sanghvi. Nikhil ran the same financial planning exercise for Mr. Sanghvi. Due to his aggressive style of investing, Mr. Sanghvi had not only been taken to the cleaners in the stock market, he had also amassed a clutch of commercial properties that were largely vacant now. The promised rents never came, and it was now difficult to exit these properties. His loans in the Hundi circuit were stuck because of the recent slowdown in the economy that impacted small and medium enterprises across varied industries, including his own textile business. The slowdown in real estate after 2013 had jammed the flow of most financiers in the city, which meant that these loans were not getting refinanced and there was no exit. In fact, Mr. Sangvi really made money on his investments and hence needed a big course correction. Nikhil painstakingly explained to him the benefit of patient long term investing. More specifically, Nikhil highlighted that investing in equity markets for the long term could create significant wealth for Mr. Sangvi and help him and his family sustain their lifestyle post retirement. The conversation was surprisingly similar to the one Nikhil had had with Mr. Talwar, even though Mr. Talwar and Mr. Sangvi were like chalk and cheese as far as their financial status was concerned. In the final chapter, we will examine Nikhil's plan to help Mr. Sangvi meet his goals. We all make mistakes. Common to Mr. Talwar and Mr. Sangvi are some very basic investments mistakes that have led to either wealth erosion or suboptimal returns. Listed below are the 7 basic investment mistakes most of us make. Number 1, no clear investment objective or plan. If you don't know where you are going, you will probably end up in the wrong place. This is one of the biggest mistakes that most investors tend to make while starting investments. They do not have their life objective or goals in mind when they invest. Most of their investing is usually random and based on market rumors or tips. It is extremely important to list one's life goals and make a financial plan to meet those objectives. The longer you postpone getting your objectives baked into a financial plan, the harder it will become for you to meet these. For Mr. Sangvi, his portfolio had, for most of his life, been just a pot of money to be used for making aggressive gambles. It was only after he sold his company that he realized that his portfolio needed a purpose and objective, namely to sustain him and his family through his retirement. Number 2, trading too much too often. Too many people trade too much too often and do not reap the benefits of long term investing and sensible asset allocation. Repeated trading and modification in investments usually lead to lower returns and higher transaction costs, which are a source of income for brokers and most financial advisors. Buying and selling investments may be fun, but if you want to benefit from long term wealth creation, patience is the key. Mr. Talwar realized that he was losing a large part of the return due to high churn that enriched his broker. Number 3, lack of diversification. Different assets carry different kinds of risk and return potential. Hence, diversifying your portfolio is very important to insulate yourself from shocks in a particular asset class. More specifically, adequate diversification across different asset classes can help in sustained long term wealth creation. Mr. Talwar's concentrated investment in property, both buying property and lending to developers, meant that when the tide turned against real estate, he was left high and dry. That being said, excessive diversification and exposure to too many stocks or funds can also negatively impact the return on the portfolio. Number 4, high commissions and fees. Paying a higher fee on your investments over the long term can have a significant impact on the performance of your portfolio. The money you pay as fees and brokerage every year compounds along with your investment returns over time. Many advisors will often recommend high cost funds or high cost advisory services to you. Don't let these high costs eat away your returns. It is extremely important to choose funds that have a reasonable expense ratio. Mr. Talwar ended up with a much lower corpus from his insurance schemes because most of them had extremely high expenses. Number 5, chasing short term returns. Most investors chase high returns or yields on their investments without really knowing the risk attached to them. A high yielding asset is a very tempting proposition, but past returns and or current high yields are no assurance of high returns in the future. It is important to focus on the whole picture and not disregard the risk you carry on your investments. Both Mr. Talwar and Mr. Sangvi got greedy and chased short term returns through developers and hundi lending respectively. When the music stopped, they suffered massive erosion in their investments. Number 6, timing the market. Markets do not move linearly and are inherently volatile. Whilst there are indicators of various kinds that reflect the market trend at any given point of time, this does not mean that one can accurately determine when to enter or exit the markets. The belief that one can catch the top and bottom is a myth. Mr. Sangvi ended up losing crores in trying to time the market. The market taught him, as it teaches all of us, that you only end up losing money in the game. Number 7, ignoring inflation and taxes. Most investors focus on absolute returns instead of looking at the real returns. To arrive at actual returns from your investments, you need to adjust or subtract the impact of inflation and taxes. Mr. Talwar was losing most of his equity returns because his holding period was less than a year, and that meant that even if he had made money on stocks, the taxman took away 15% of his gains. Also, both these gentlemen held gold, believing it to be a great asset, but on inflation adjusted basis, gold did not deliver much for them. In the 27 years since he started working on the 1990s, gold delivered an inflation adjusted return of just 2% per annum for Mr. Talwar. Exhibit 5, gold has hardly delivered any returns adjusted for inflation. Invested amount of 1 lakh rupees. Reading the chart, gold 1 lakh rupees invested in 1990 is 11.2 lakh rupees in 2017 with a CAGR of 9.35%. But the inflation adjusted gold is only 1.7 lakhs during this period, and the CAGR comes to only 2%. The Coffee Can Manifesto. Most Indians do not invest in equity at all. Those who do so in a very haphazard manner. The result is that the long term gains from what is very powerful asset class have eluded the majority of affluent Indians. Granted, equity carries more volatility, but the rewards more than compensate for this. Also, volatility is sometimes overrated. For a saver looking to build up a corpus for the next 20 or 30 years, 2 or 3 years spurts in volatility do not matter. The longer the time horizon for your investment, the higher should be your investment portfolio's equity exposure. It thus sounds counterintuitive for investors when they are told, for example, that they should increase their equity exposure from 5% to 75%. Yet, over a span of 20 years, while the volatility seems like an afterthought, the difference in returns becomes staggering. An investor holding rupees 5,000 in equity and 95,000 rupees in debt, assuming 15% and 7.5% compounded annualized returns respectively, will end up with a corpus of 4.85 lakh rupees in 20 years. If, on the other hand, the equity component was 75%, that is 75,000 rupees in equity and rupees 25,000 in debt, the same investor would have a corpus of 13.3 lakh in 20 years. In the course of the next few chapters, we will lay out a very different way to make money and generate serious wealth in India without taking toward risk and making your broker or financial intermediary rich. Most of these practices are quite intuitive and are followed by only a few. In chapter 2, we will demonstrate how to build a coffee can portfolio using consistency of historical revenue growth and return on capital employed. Such a portfolio beats benchmarks across all time periods and also perform admirably well during stressful periods like the Lehman crisis in 2008 when the overall stock market nosedived. If invested for over a decade with no churn, this portfolio generates returns that are substantially higher than the benchmark stock market index in India, the Sensex. In chapter 3, we study the impact of expenses on the value of portfolio. We also witness the evolution of mutual funds globally and in India. Along with this, we also learn the difference between active and passive funds. Globally, we are seeing a massive shift in investment flows from active funds to passive funds because active funds are no longer giving the outperformance they used to, and passive funds are far cheaper. In India, we see the large cap mutual funds outperformance vis-a-vis the Sensex has more or less vanished. However, they still continue to charge high fees compared to their global counterparts. In this chapter, we also learn about the introduction of direct mutual funds and the concept of advisory versus distribution. In chapter 4, we take a look at the real estate, the asset class which accounts for the lion's share of most Indian investors' portfolios. We study, in contrast to popular perception, how residential real estate has given very poor returns to investors over long periods of time. We also show the other disadvantages of this asset class: high transaction costs, illiquidity, and suboptimal taxation. Along with that, the bubble like valuations in the residential real estate in India forebodes sustained underperformance in this asset class in the foreseeable future. Commercial real estate, on the other hand, appears to be far more promising asset class in India. In chapter 5, we analyze the potential of smaller companies to outperform large caps in India. The NDA led government's multi pronged attack multi-pronged attack on the black money is resulting in the active diversion of savings away from physical assets to financial assets, which in turn benefits the smaller businesses disproportionately relative to the large household names that dominate the stock market. Again, in this backdrop, we analyze two key drivers of outperformance of smaller companies. They have the potential to grow their profits much faster than large companies. And secondly, as small companies grow in size, they are discovered by the stock market. In Chapter 6, we demonstrate how patient investing, that is, holding stocks for longer than a year in high quality stocks, help an investor generate outstanding returns with low levels of volatility. While intuition suggests that a shorter investment horizons are akin to speculative investing, where investors do not need to focus too much on the quality of the company, our analysis show that even for short term horizons, high quality stock picking is central to generating high healthy returns. In Chapter 7, we put our learnings to work to build good quality investment portfolios for Mr. Talwar and Mr. Sangvi. We study the importance of financial planning as an exercise to match investments with life goals. By combining coffee can portfolios, exchange traded funds, small cap funds, and liquid funds, we help Mr. Talwar and Mr. Sangvi look forward to a financially secure future. Finally, in Chapter 8, we put our takeaways from the preceding chapters to work to create a financial plan for you using the Ambit financial planning tool. Three takeaways from this chapter. Number one, it is critical for an investor to nail down objectives and bake them into a financial plan. The exercise helps match the investor's financial goals with the kind of risk that needs to be taken in the portfolio. Number two, it is important to not adhere to the age old wisdom of investing heavily in the fixed deposits, real estate, and gold. These assets have underperformed equity by significant margins over long periods of time. In fact, these assets have often given returns lower than inflation over the long periods of time and thus damaged investors' wealth. Equity remains the most powerful driver of long term sustainable returns. However, investors need to be patient and systematic with equity investments. They also need to keep their brokerage and financial intermediation fees low. Chapter 2, Coffee Can Investing. For indeed, the investor's chief problem, and even his worst enemy, is likely to be himself. Benjamin Graham, The Intelligent Investor, 1949. Framing the investment problem properly. Sir Isaac Newton was one of the smartest people ever, but being a smart physicist is not necessarily the same thing as being a smart investor. Unfortunately, Newton learned this the hard way. In an updated and annotated text of Benjamin Graham's classic, The Intelligent Investor, Jason Zweig included an anecdote about Newton's adventurous investing in the South Sea Company. Back in the spring of 1720, Sir Isaac Newton owned shares in the South Sea Company, the hottest stock in England. Sensing that the market was getting out of hand, the great physicist muttered that he could calculate the motions of the heavenly bodies, but not the madness of the people. Newton dumped in his South Newton dumped his South Sea shares, pocketing 100% profit totaling £7,000. But just months later, swept up in the wild enthusiasm of the market, Newton jumped back in at a much higher price and lost £20,000, or more than $3 million in 2002-2003's money. For the rest of his life, he forbade anyone to speak the word South Sea in his presence. Sir Isaac Newton's experience back in the 18th century is not too dissimilar to what most stock investors have faced in India. Newton obviously was not unintelligent, neither is Mr. Talwar nor is Mr. Sangvi. Newton invented calculus and conceptualized the path breaking laws of motion, but this little episode shows that he was not a smart investor because he let his emotions get the best of him and was swayed by the irrationality of the crowd. Successful equity investing largely hinges around answering two simple questions: which stock should I buy, and for how long should I hold the stocks I bought? These questions are simple but not easy to answer. In a typical social gathering in Mumbai, the most common topic of discussion is which stocks should one look to buy or sell. The people answering this question usually make the following statements: I had bought XYZ stock 12 months ago and it has almost doubled since then. Or you should buy XYZ stock today since it is likely to do well over the next 6 months. Such discussions on investing, however, helped Mr. Talwar, nor Mr. Sangvi, nor Sir Isaac Newton when it came to figuring out answers to questions regarding which stocks to buy and for how long to hold these. For the vast majority of equity investors in India, investment becomes a complicated affair, not only because they are surrounded by substandard advisors, but also because they imbibe or are fed incorrect investment theories. The most common one being that to make higher returns from the stock market, one must take higher risks. Such misconceptions in the minds of the investors blur the demarcation between punting and investing, as investors respond to ephemeral events. As investors respond to ephemeral events which corrode their capital and enhance the wealth of intermediaries. Punters who incorrectly think and call themselves investors buy shares in a company because a friend of a friend says that they have heard the stock price could go up. Or they trade in small cap stocks, cyclical stocks, or beaten down stocks without really knowing what the company does, how honest and capable the promoter is, and what risks are associated with the investments. These punters not only have no advantage over the investors in the market, they actually have less information compared to the professional fund managers. Hence, in all likelihood, they end up losing more money than they make in the long run. Sir Isaac Newton, Mr. Talwar, and Mr. Sangvi are all punters destined to be taken to the cleaners by stockbrokers feeding off their vulnerability. Investment philosophies from the legends. An investment in knowledge pays the best interest. An investment in knowledge pays the best interest by Benjamin Franklin, 1706 and 1706 to 90. So, if we leave the punters behind and listen to those who have methodically thought through how to stay patient and make a great deal of money in the stock market, what can we learn? In Berkshire Hathaway's 2007 letter to shareholders, Warren Buffett explains that the kind of companies he likes to invest in are companies that have a business we understand, B, favorable long term economics, C, able and trustworthy management, and D, a sensible price tag. A truly great business must have an enduring moat that protects excellent returns on invested capital. The dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns. Business history is filled with the Roman candles, companies whose moats prove illusionary and were soon crossed. Our criteria for enduring causes us to rule out companies in industries prone to rapid and continuous change. Though capitalism's creative destruction is highly beneficial for society, it precludes investment uncertainty. It precludes investment certainty. A mode that must be continuously rebuilt will eventually be no mode at all. Long term competitive advantage in a stable industry is what we seek in a business. On the subject of for how long should an investor hold the shares they buy, Warren Buffett in 1988's Berkshire Hathaway's letters to shareholders stated, when we own portions of outstanding businesses with outstanding management, our favorite holding period is forever. We are just the opposite of those who hurry to sell and book profits when companies perform well, but who tenaciously hang on to the businesses that disappoint. Peter Lynch aptly likens such behavior to cutting the flowers and watering the weeds. Roger Lowenstein's in 1995 book Buffet, The Making of an American Capitalist, states that Buffett's style of investing was perfectly learnable. However, there is a duality there. Part of the duality was that people confused simplicity with ease. Buffet's methodology was straightforward and, in that sense, simple. It was not simple in the sense of being easy to execute. Valuing companies such as Coca Cola, Berkshire Hathaway's largest investment in the late 1980s, took a wisdom forged by years of experience. Even then, there was a highly subjective element. Most of what Buffett did, such as reading reports and trade journals, the small investors could also do. He felt very deeply that the common wisdom was dead wrong. The little guy could invest in the market so long as he stuck to his Graham and Dodd knitting, but many people had a perverse need to make it complicated.